These are crazy times. The market has seen crazy gains and losses over the past month or two. We continue to get sky-high inflation ratings month after month. Everything is more expensive these days, from gas to groceries and a lot of the necessities that most Americans need every single day. We also just got a huge 0.5% rate hike from the Federal Reserve, the largest rate hike since the year 2000. I think it's fair to say that many investors are skittish. They're nervous and full of anxiety. But that's not me. I'm not nervous and I'm not full of anxiety. I'm being serious. In fact, if you are a dividend cash flow investor, then you shouldn't be either. I know that this runs contrary to most of the stuff you hear on the news and even what you hear from other creators here on YouTube. Let's talk about it. So why are most people so nervous right now? Well, most people should be. Inflation leads to everything costing more money. For people who are retired or will retire soon, this leads to either spending more money than you intended or making huge cutbacks to spending, possibly even having to go back to work. Many people are focused on the overall portfolio balance of their 401k or their IRAs. Well, that makes sense because their cash flow is derived from selling shares of stock. Now, this is a double whammy, for lack of a better term. Let me explain. So when inflation is high, you have to spend more money, aka you have to sell more shares. And when retirement account balances have taken a huge hit, this is the worst time to sell shares because it impacts your future growth and income. This is known as sequence of returns risk, and it can have a detrimental impact to your retirement. Here's what I mean when I say sequence of returns risk. Let's say this is your portfolio right here. It's coming along very nicely here in the green, and there's no problem selling shares as we're moving along. But what if we have a severe market downturn, as evidenced in the red line? What if you really need income right down here? You may be forced to sell shares, and you might think, well, that's not that big of a deal because remember, you're selling shares to generate income. But when the market rebounds, when it comes back up, as evidence between these two lines here, you are capping your future growth and earnings with this black line here. This is how high your portfolio is going to go because you have fewer shares to grow. Whereas if you didn't have to sell shares at that low market time, the value of your portfolio would be up here as evidenced by the green line. This is the difference that sequence of returns can cause, and it can cause severe ramifications for your portfolio when you're much older, and it could cause you to generate less income from your portfolio or shorten how long the portfolio will actually last. Here's what sequence of returns risk can look like over time. Let's take a look at this red line here. We can see as the red line goes down that the amount of money that the portfolio comes up by every time gets smaller and smaller. And if you look at these red lines here, these would be where we might sell shares at the worst possible time. When we do this, our portfolio continues to go down and down because it can't grow because it has fewer shares to grow with. Now, if we compare and contrast this with the green line here, right, it looks exactly the same until that first drop, that big drop where that black line is. Instead of selling shares, we're continually able to grow. And this is where it starts to outperform, and then it still drops. The market volatility still causes a drop in the portfolio, but you'll notice that it's at a higher level, and it continues to rebound from that low, whereas the other portfolio can't do that because it has fewer shares that allows it to grow. This is how much of an impact that sequence of returns risk can have on your portfolio. So given inflation and significant Federal Reserve interest rate hikes and large drops in account balances, why am I not worried? Well, first off, I'm young. And that is something that younger investors or even middle-aged investors need to remember. If we don't need the money right now, why are we losing sleep over our account balances? We are literally creating anxiety for ourselves that doesn't need to be there. Now, I know that this does not bring a lot of comfort to those of you who are already retired or are planning to retire right now or really soon. But the second reason why I am not concerned or full of anxiety despite what we're experiencing in the markets is because I am a dividend cash flow investor. Now, you might be thinking to yourself, what exactly is a dividend cash flow investor? You may already be familiar with the term dividend growth investor. This is somebody who invests in companies that do pay a dividend, but they're primarily focused on growing earnings and their stock price. Think of companies like Apple, Microsoft, even companies like Costco. Yes, they do pay a dividend, but their dividend yields are very low. But growth is strong. A dividend cash flow investor is different. This is somebody who invests in companies that pay healthy dividend yields and are more stable companies. They're not growing like crazy like these other companies, Apple, Microsoft, and Costco and other companies. Instead, they're stable companies. They are through that stage of the business cycle. They are very profitable, and they are consistently profitable every single year. And what's more important, they are raising their dividend, increasing it every single year. An example of some of these companies could be Coca-Cola, Pepsi, United Health Group, AbbVie, ExxonMobil, and Pfizer. The focus is on cash flow right now. These are the type of companies I like to invest in. Back to what I was saying though. Why am I not worried, nervous, or full of anxiety? This stems from the fact that as a dividend cash flow investor, I am not selling shares. I am living off of my dividend income. Even if my portfolio drops 25 to 40%, this does not cause me any concern. I am focused on the cash flow and the companies that pay it. Furthermore, inflation doesn't bother me either, even when it's sky high at 7%. How could this possibly be true? Let me explain. Inflation erodes purchasing power. You've probably figured this out by now. This directly impacts investors who have to sell more shares than normal, and maybe even some dividend investors. But I have a simple solution. Invest in dividend stocks that consistently raise their dividend every year by at least 5 to 10%. Now you might be saying to yourself, it must be hard to find these companies, or maybe there just aren't very many of them. This is not the case at all. In fact, I found 289 dividend stocks that have consistently raised their dividend by at least 5% over the past 1, 3, and 5 years, and they've paid increasing dividends every single year for at least the past 10 years. When the companies in your portfolio are paying dividends at an increasing rate, matching inflation, or even maybe more than inflation, your income every year is going up, even though you're not buying more shares. Now, this doesn't mean that all 289 companies I mentioned are great fits for your portfolio, but it's a great start. I will dive into these stocks in my next video, and they are available in the monthly dividend stock spreadsheet when you join the Patreon community. If that sounds interesting to you, there is a link to join down in the description below. When inflation is hot, the Fed is raising rates, and the markets are down big, most investors freak out. But like I've said, that doesn't need to be you as well. If you liked this video, check this one out right over here. It's a great next step to help you start buying quality dividend stocks. That's all I got for you guys in this video. Have a great rest of your day. And please continue to stay healthy, both physically and financially. Have a good one.